4 of the What is Money podcast, the most recent that has dropped, said you talked about how the inflation rate sets the floor on bond rates. And he's curious about how shrinkflation plays into that equation, if at all, or if it is just a way to hide the real rates from the market for a little while longer, for, I guess, more pain.
Well, this is exactly what. So Greg's looking at it from a different angle, but it actually converges exactly the same. So what caused? I look at it from what caused the debt buildup. Greg looks at it from how big are credit markets and what's going to happen next. And so he's completely right. People are looking at the equity markets thinking they're going up, and the credit markets is where really all the action happens. And so what I wanted to say, what I explored in the book and others, is if you have deflation or technological deflation, what governments are doing is trying to counteract that, and that has been the low interest rate policy to try to drive growth against that. And the lower interest rate policy of constant lower interest rates causes debt bubbles and people to misallocate capital and bring more debt. And then when that can't be paid, then monetizing debt is what happens. And the real risk starts to be, well, if you looked at the world today, the real risk is if anything stops. So if governments stop printing, you're going to see deflation, and you're going to see a deflationary depression. But to the point that Greg's bringing up, is the counterparty risk is all the way down to the sand. Nothing's backing it. So if that happens, you just keep on unwinding all the way to the ground. Every bank fails, every institution fails, every government fails as a result of that, allowing the natural forces to work now, because it's counteracting a different system. So the real risk becomes a reset of the debt itself, or a wipeout of the debt itself. But because our entire system relies on that debt and everything else is built on top of that risk-free rate, everything collapses. So you have to ask yourself, will governments allow that to happen? And I think quite simply is they can't. So they will continue to print and to pretend that debt is still repayable. And so they default in a different way, and that's where we are in the cycle right now. And so what you're starting to see is the CDS spreads are rising as a result of knowledge of what's going to happen next.
How widespread do you think that knowledge is now, Jeff?
Well, so I think a lot of people in specifically in Bitcoin are understanding that it's the best risk-free trade in the world right now, and the more and more people are starting to understand that, and that's actually why a wall of money is coming to Bitcoin, and more people are starting to get that. Not just individuals, but now companies and eventually sovereigns themselves as well. Is that's what's happening. But how wide is that knowledge today? I would say really narrow. It was so small, because, and I've said this so often, we measure a system by the system we're in. So even though everything we're talking about is true, it's factual. They try to defend anything, poke holes in what we're saying. And from a first principle standpoint, you can't. So that means that the existing system requires manipulation and exponentially more manipulation to survive. And if you think, what is actually inflation? So inflation is, and this is going to sound harsh, but it's true. So if you take something from somebody else without their knowledge, is that theft? And you would say, so if you took something from somebody without their knowledge, it's theft. I know that's a harsh word, but it's theft. And so when you transfer wealth from the middle class and poor to the rich with the inflation, and you hide it, and even if people don't know, it's theft. And so then you should ask, what is it theft if it's 2%, 3%, 5%, 20%? right? Theft is theft. And so what's happening right now, and more people are understanding that theft and the consequence, more the geopolitical consequence, the rise up of societies and everything else, and the wealth divide. They were understanding that consequence more. And so what is the existing system going to do? We're going to create more theft to pretend we're going to save you. And so that's what's happening today. And more and more people are investigating this on a first principle basis and starting to understand that the world they lived in might not be as true as they think. And something's going to change. So, but today, a very, very small percentage of people understand what we're talking about.
And can I jump in? It's even in the credit markets, okay? Even in the credit markets, there are bond guys that come back at me. Well, have fun. I'm sure you made a lot of money shorting those Canada bonds. And meaning the price of the Canada bonds went in my face if I was shorting the bonds. And I wouldn't short the bonds. The bonds trade down because they're manipulated down. You need to own protection. You need to own an insurance contract that is not manipulated by a central bank, that can be reflected in open market forces. It's a floating rate premium, has nothing to do with, or no direct link to inflation expectations. There is from a credit perspective, but you need to watch those credit spreads. And I go back to the great financial crisis in 2008. And the credit spreads were the early warning system, the canary in the coal mine, okay? I lived that. I traded at a hedge fund with a very famous Canadian. I'm not sure if we've ever brought his name up, Jeff, and I'll talk to you about him later, but he was an equity guy that basically said, Fosser, here's all, and he had a large position in the fund, take all my risk and manage it from the equity side, from the credit side, because equities don't matter, okay? Yeah. Equities are the tail of the dog, and the dog is credit. And when the credit market is not happy, equities get destroyed. Very simply, why? Because credit guys can hedge a subordinate claim. If you have sold protection on a given name, you can run to the equity market and do option strategies or outright short that stock because you've sold a default insurance to some other person that needed the insurance. And therefore you run out, and in the subordinate claim in the capital structure, you, for example, could have shorted Lehman Brothers, and Lehman Brothers equity starts spiraling down, and then the crisis in confidence. So, not jumping on top of you, Jeff, but the truth is, yes, it's a minuscule portion of people, even in the credit markets, that understand credit default swaps. It's a brilliant invention by two young ladies out of JP Morgan in New York, obviously New York, and they developed a market, and that market is very valuable, and it's often an early warning system. And even when it's even when there's a fire, there's still protection. It's like they're trading fire insurance during when your house is on fire, because maybe the house doesn't burn to the ground. And all of this is very key. It is such an important innovation in the markets that separates inflation from credit.
And let's just build on that for a second, because even the CDS market, Greg, and I'd love your comments on here, because even that isn't understood well. Those spreads are essentially assuming the counterparty could pay, right? And
yes,
what happens on those spreads, and so even the CDS market can't tell you the truth on how bad it is, because it requires a counterparty on the other side to pay that. And what you realize is going down the stack, it kind of a wall of nobody can pay.
You're 100% correct. Sorry, but imagine if somebody had purchased, let's say Greg Foss had purchased default protection on Lehman Brothers. Just saying, I did not do that, but let's just say I did. But imagine if I had purchased it from Bear Stearns.
Totally.
And imagine then I thought I was hedged, but Bear Stearns is going down, cascading downwards as well. All of a sudden, I'm concerned with my counterparty risk on Bear Stearns, because it's not direct Bear Stearns. It's an insurance premium I'm paying to Bear Stearns to hedge me against Lehman Brothers. Then all of a sudden I have to run out and say, my God, I got to insure the insurer. And then that again is
the next one. Who's the next one?
So that's the domino effect. That's why it happens. So you're 100% correct. The counterparty component is such an important component, and we'll talk about this later. Maybe bringing up the aspect of AIG and what that would have meant to Goldman Sachs if they had let AIG fail in 2008. So over to you guys.
This holiday season, give the gift of Bitcoin to your loved ones. Swan delivers your Bitcoin gift along with our world-class education and client service. Create a Bitcoin gift and wrap it with a custom message for your family and friends. Dash away with your gift. Your recipient will receive an email right away, that easy. Give the gift of generational wealth. Give Bitcoin.